All right, welcome to the call. Peace and success to you all. I'm excited to bring you this information. A lot of our student members have been buzzing about the upcoming stock market masterclass, and it may be out by the time you see this, and so this should be included. This will be just an introduction and an overview about stock market investment strategies. So we'll get deeper into each section and the details of everything a little bit later in the course. This will be in the Personal Finance Success Path curriculum if you're curious. But like I said, this is just an overview. I want to get you an idea, you know how I do, kind of a perspective and a context on everything, so you know what you're getting into as you're getting into it, right? Our network of instructors are made up of quite a few entrepreneurs in many different industries. But interestingly, all these different industries and all these different entrepreneurs, many of them are also stock investors, and many of them are successful stock investors. So our network has introduced us to a lot of people who are very privy on personal finance, and we put them in this course. Okay, so we have some of the brightest minds helping out, but I also want to tell you about that it really doesn't matter about the accolades of the teachers. Their experience is necessary, their perspective is necessary, but we're bringing you information. It kind of leads me to our disclaimer, is that this is not advice on investing or taxes or any legal matters. This is information. To provide advice, quote unquote, you have to be certified in certain areas by certain municipalities and boards and things of that nature. And we try to stay away from that in all our classes, really. What we do is provide you information. And we suggest against taking advice because we don't know your detailed situation. We want to give you the information, and really no one does. So any advice that you think you're getting, take it as information, digest it, apply it to your current situation. All right, the first thing I want to kind of just say right off is that all strategies work when it comes to stock market investing. Everybody asks me which strategy does this, which strategy does that. You want to understand that all strategies work. There are multimillionaires in every area. The day trading, dividends, ETFs, options, penny stocks. There's multimillionaires in all those areas. They're just not optimized for every person. So in other words, they're not going to work for every person, right? They're only going to work for people who's suited and who's set up for that particular type of strategy. And we're going to get into how you evaluate them all and determine what's best for your situation. And it's going to be a combination. I'm going to guarantee you that, because these are very general terms, very general groupings, and what you do is you pull out what fits for you out of the different strategies to create your own combination of strategies for your own portfolio. Okay, and that's what we're trying to walk you through here. And like I said, we'll get deeper into in each area by the course. So the first thing that you want to ask yourself when you start investing is, when will you need the money back? And I'll explain a little bit in detail here in a second, but that determines what type of strategies you're going to get into, or helps determine what type of strategy you're going to get into. So say you buy $100 worth of stock, right? This is just an example. What if that stock that you bought $100 today went up to $200 worth of stock tomorrow? What would you do with it? The first thing you have to ask yourself is when you need this money back. Do you want it back today? Do you want to take your girl out for 100 and put the other 100 back into the stock and see what happens? Or leave it in there and see what happens? Do you want to take the total 200 out, look for another stock and reflip? Do you have some other investments that you want to use it for? So you have to determine when you will need the money back. That'll determine whether you keep it in there or take it out. Because let's say you keep it in there for 30 days. You didn't really need it the next day, or you didn't owe nobody any money, right? If you keep it in there for 30 days and it dropped down to $50, so now your $100, you missed out on doubling it, and now it's at half. Now what you're going to do, right? Once again, when will you need this money back? Was that your light bill money? Right? If your light bill's $72, you put 100 to see if you can make a little bit. You was happy when it hit 200. Now you're short. You may want to be pulling out at $50, depending on when you need this money back. Right? A lot of people see this and they say, "Oh, I'm a swaggy investor," and what they'll do is hold the money in too long because they haven't determined when they need the money back. Right? So let's say you don't need it for lights, which we don't suggest you using any of your immediate bills or utilities on investing in stocks. We'll get into all that in detail later on in the course. But let's say you wait 6 months trying to ride it out. Hopefully it'll get back up to that 200. Next time it hit 200, you pull it. But it doesn't do it in 6 months. Now you're down to $25. Now you're pushing the alarm button. Now you're desperate because you needed this money. For maybe a car or your investings or something like that, short-term savings. Maybe you borrowed it. Maybe you, owe somebody some money or have some bills due coming up. You needed that money, and now you don't want it. You don't want it to go to zero, so you pull it out at 50 or you pull it out at 25, depending on when will you need this money back, right? Now, what if you don't need the money back for a while? What if it's your 6-year-old's college savings, right? Or something like that, something long term. Then you can ride it out. Then it can still be in there. You don't need that $100 in there for 2 years. You can ride it out and hit 200. But it might not hit that, hit 1,000. It might not hit that 1,000 for 5 years down the line. So you need to determine when you need that money back, how long you want to wait to get your money back or to get your gain, right? To make the gains that you expect to have. Now, this is important in multiple ways because not only is this the first question you should ask when help determining your strategy, but this is going to be important for you to understand this about yourself, about your own situation, about each investment, about each stock, because this will help you determine when to sell. And that's one of the hardest parts. We'll get into it in detail later on, but it's a lot easier to know when to buy. Oh, this buzz, this price hasn't go up, we about to get on it and buy it. Yes. But when do you sell it? When around here do you sell it at 200 the next day? Do you sell it at 50 or 25 before it goes to zero? Or are you confident that it's going to go up to 1,000 later? One of the first questions, again, I'm going to reiterate this, is when will you need the money back? And this is different for each individual person, and so this will help you determine. That's what each individual person sells at a different time. Okay? Let's move on. Now, again, when will you need your money back? This will help you determine what type of, again, these are general terms, but what type of investor you are or trader you are. Okay, so long-term trading is like dividends. They take years and decades to make a gain, but this preservation. It's preserving your wealth. It often replaces your savings and retirement, and that you slowly grow. You're going to grow with inflation. You know, if a hot dog costs $1 now and it costs $2 30 years from now, your inflation, your slow growth have made you $2 by then. So you're able to basically buy the same thing. It's very slow, and but it's very safe, right? And a lot of the big wigs do it. And if you have a large amount of money and don't really know where to put it, a lot of them do it as far as putting their savings and their retirement in it, because it's a little bit better than banks and traditional savings accounts that even go even slower and even longer term than this. Okay. The next is a swing trader, which is kind of in between, a middle ground person, which is most people. These are people who are too busy to check the stocks every single day to day trade. Right? This takes months, weeks, and days, and this time frames are to execute buy and sell trades, buy and sell your stocks. These are execute trades after your your research. Right? It's the most popular, and it's used to grow your net worth and your savings. Grow. not necessarily preserve, because you're putting it into more risk, right? Not necessarily as income on a daily basis, but you're growing your net worth and your savings. And then you can use the profits and things of that nature in other areas or in other stocks without waiting a real long time, and without going up and down as far as day trading, because day trader has many advantages, but it has many downfalls as well. So day traders are people who buy and sell within the same day. You have your fastest and biggest gains and losses in day trading, and it's money that you need to be able to lose. That's why we put desperate or money to blow. Because when you're desperate and when you have money to blow, there's something similar there. Let's say you got $10 or $100. If you're desperate, you're putting your last $100 in. Keeping that $100 really doesn't do enough for you. Putting it that last $100 in to see what happens is a desperate play. You're going back down to zero is not much of a loss when you're at a desperate situation. And similarly, when you have money to blow, that $100 doesn't weigh as much. It's the in-between ground, when it's bills, when the money's tight and you got mortgages and things of that nature, where you need this money within a reasonable amount of time, is where you need to stay away from day trading, because it is risky. And I say stay away from it initially until you know what you're doing, because I don't recommend you stay away from any of these once you know what you're doing. Okay. The thing about day trading, it's more technical and more expensive. By technical, I mean, we'll talk about here on the next slide the different types of research, but it's a technical research. It's looking at charts. It's looking at people's emotions and what happens on a day-to-day basis. It's not really looking at the 70-year history and the financial ins and outs and profit losses and things of that nature. It's more of a technical right now, what's happening right now with the other investors and their emotions. Okay, and it's more expensive. It's so volatile that the market, most brokers, require you to have like $25,000 in their account before they let you day trade. The only other options in day trading is either to tag along with someone who has an account like that, where they give you access and let you make your money, or there's also a way where you can use different platforms to stay under your daily trade limit. And we'll get into that technique later in the course as well. But in general, it's more technical and more expensive. If you ever see those big, those big vertical screens side by side, and these, 4x4 foot computer screens, and they all got these stock market deals up, they're day trading. And they're day trading, and they're looking at the technical analysis on a regular basis during the day, so that help them make the trades. And again, the types of research we spoke on a little bit earlier, but it helps determine your investment strategy, right? So fundamental analysis is the old school traditional researching stocks. You check out the company, you see how long it's been around, you look at the profit margins, you look at the expenses, you look and see how much it owes, you look and see at the board of directors and see how much experience they have at their job and things of that nature, so you can purchase and invest in sound companies, right, that are going to continually grow. This takes time. This takes time to kind of get to know the company. You got to get to know these people. You got to do some research. You got to get on their insiders list to stay up to date on things. And when you're looking at a bigger company, the technical analysis is a little bit less important. What they do from day to day, whether they hit the news and release a product here, or release a product there. When you're looking at the fundamental analysis of a company, you're looking at what the company might produce before it's even thought about producing, what their strategic goals are, what their next 3 or 4 years worth of production is. So you're going to be around as an investor in that term. And so that's usually best for long-term research or long-term investments. So fundamental analysis is very helpful and usually best for long-term research. Not to say that you don't use it in other areas, because I'll get into that, but these types of research you put in, you put small parts into your strategy. All right, so technical analysis, instead of focusing on the company, you focus on the market. You know, you're going to look at the charts. You're going to look and see if it hits $3 and every time it hits $3, it goes up to 60. That's going to be something that you notice. They call them trends. You're going to look at the Fibonacci, which is a natural order of how human brains and people and emotions work. So you're going to look at charts and trends, and you're going to be focusing on the market, the buyers and other investors and traders, right? And that's best for the trader. This is best for the people who need the money within the next couple weeks, couple days, couple months. They're more affected by the charts and trends. It could be a very strong company. It could be Taco Bell, and the CEO, you know, punches an Uber driver and the stock drops. But it can be a very strong company. So the stock may drop now, but in 3 or 4 years, in the bigger picture, if it's a strong company and a fundamental analysis stacks up, then it won't take that much of a dip. It just depends on when you're trying to make your money, sooner or later. Okay, there's benefits of both, and you want to understand the differences of the two different types of research. So the fundamental analysis takes a little bit more time. You got to have more time to do fundamental analysis. Technical analysis takes a little bit less time, but it's a bigger learning curve. So again, the research that you're going to do and that's right for you helps determine what investment strategy is right for you. Okay, and the next thing is the size of the stock. That helps determine your investment strategy as well. And I just want to give you a quick example. We'll get into the details later. These are 4 stocks that I personally have shares in, and I just want to give a quick example. So if you buy $10 of each of these stocks right now, and I gave the price there and I kind of rounded them, but this is approximately the current price. Healthy Choice, HCMC, which is a nano stock, a nano market, or a micro cap, or a nano cap. They have a lot of names. Penny stocks, they have a lot of names, but these stocks are, for 1 share, is less than a penny. They're perfectly fine to invest in. They're just a little bit more riskier. We got a whole section on that, so we're going to get into details on that. But I want to give you an example. HCMC, WTER is alkaline water. We know Tesla and we know Amazon. And these are right up under their tickers are their approximate price right now. Now let's say at that approximate price we bought $10 of each. Okay? And yes, you can buy $10 of a $3,500 Amazon stock. It's called partial shares, and we'll show you how to do that. Same thing with Tesla. Even though it's $700 per share, you can buy $10 worth of a share of Tesla. Okay, so if they all go up $1, down at the very bottom is what your return will be. I don't want to go too much into it. I just wanted to have you take a look at that. If you bought Amazon, $10 of Amazon, when it's at $3,500. If it goes to $3,501, you make 3 cents. Tesla, it's at $700. If you buy $10 of Tesla and it goes up to $701, you make 14 cents. Water, alkaline water, is $2. You buy $10 of alkaline water, you've actually bought 5 shares. And if they go up $1, then you make $5. HCMC, as you can see, that is less than a fraction of a penny per share. I'm not even sure, there's a quick calculation, I'm not even sure how many shares that is. I think for $10 you're getting 16,000 shares. So if they go up $1, if it goes up to $1.0006, you make $16,000. Okay, so I want you to see the difference in percentages. A lot of it is about percentages and size, but I also keep in mind Amazon probably has went up and down $1 every day in the last 2 years. HCMC, for example, has never went up $1, right? So how often that happens is, and a lot of it's based off of the type of research, both types of research that we just looked into, and determining what your plays are. Okay, so I just wanted to give you that. We're going to go deeper into that. We're going to get into millionaire math. We're going to get into calculating different types of investments and things of that nature, and the risks along with it. Okay. When you trade is a strategy in itself. Now, when you trade, what time of day, what day of the week, is a strategy in itself. Okay, I won't get too deep into this. This is the only slide on it, but these are the times some people's strategies to invest depend on when they trade, and yours will be too once you put this information into work. So market opening and closing jumps. There's a time when the market opens and a time when it closes. Based off people's emotions, as soon as it opens, a lot of people buy or a lot of people sells. Right before it closes, a lot of people buy or a lot of people sell. Once you start to research that, you see what's trending with certain stocks and certain types of investors, you can be able to take advantage of that. Maybe invest before the fact, or be part of that surge, right? IPO investing and shorting. So IPO is initial public offering. This is the first time that the public is going to be able to invest in this stock. Some people only work around IPOs. Some people think there's a strategy where you're going to short the IPOs. I think it's 80-something percent, 85% of IPOs drop as soon as they come out, because there's this big override, and then it's released to the public and everybody gets scared. So there's a big drop. So if you can short it early on, you can look into getting into IPO companies before the public offering. You can watch the dead cat bounce, which is when they do drop, but they come up a little bit early on. So you can look into that type of strategy. And what you want to do, we'll get into details on these, and we'll show you what's applicable to you. If you're not able to be around during opening and closing of the market, if you don't have the investment amounts or the amount of money to put in when it comes to IPO investing, these might not be for you. So we're going to go over the details, and you can determine on your own if you understand what we're trying to do here. Okay, and in publications, this is like current events. This is companies put out their earnings reports on a regular basis. They put out press releases on new products, new joint ventures when they buy something. If you're part of their investment team, they might send you a little email and let you know ahead of time. FDA and pharma approvals. They approve company products on certain days. So you can, if you know you're going to get approved, or you know that there's going to be some movement ahead of that date, you look up the date and you make your investments accordingly. So you can make your investments according to publications, which is part of the when you invest, right? Insider info, like I said, if you are already an investor, or if you follow someone who has the time to really dig deep into the research, you can use that information as part of your investment strategy. And then again, news and current events, whether the CEO hits Uber, whether the pandemic comes through, whatever may happen, if it's in the news or if it's on social media or if you hear buzz or something like that, it may affect the stock that you're looking into. Okay, and some people are on top of that so that they can take advantage of that. Okay. And that's really all I wanted to get into for right now about market investment strategies and creating your own personalized investment. We're going to go into details later in the course on each strategy. We're going to walk you through over the shoulder. We're going to log in. We're going to make some money with you, right? And then also want to say, okay, let me say this before I exit out. There's a mindset that we're going to have to put you in. Everything that you point at, you can close your eyes and point, and there's a multi-million-dollar company that makes it, right? From your socks to your headset to whatever you see on TV. I need to get you in a mindset, instead of looking at items and things, you're seeing products and companies, and you're like, oh, that's cool. Who made that? Let me look in to see if that company's on the stock exchange. If the stock market masterclass is not out yet, it's coming. It's going to be just like all our classes, continually updated. It's going to be have its own student member forum, just like all our courses. There's no, there's no 2.0, there's no 3.0, and buying for this guru and buying for this one-trick pony and things of that nature. We're going to get all the information, and you're going to be able to get some help along the way, and you're going to make your own sound investments according to your own situation. That's what we're trying to do. You'll see me later on in this course, because I'm going to do the course challenge. Take some notes, because we do have some very important videos from other instructors coming up. But on the course challenge, again, we're going to log in and walk you through some things. Thank you for joining the call. I'll get all these questions answered in the chat, and I'll talk to you later. Thanks.